Welcome back to Morning Trade Live. It's time for the big picture, so let's welcome in the team from Charles Schwab. Collin Martin, Head of Fixed Income Research and Strategy, Schwab Center for Financial Research, and Nathan Peterson, Director of Derivatives Analysis, Schwab Center for Financial Research. Okay, let's start with you, Collin, because obviously it's been a big fixed income story. What we're seeing with these JGBs, a bit of a relief overnight with the 10-year auction that seemed to get some strong demand there, but these yields still remain elevated, and we currently still have the US 10-year at 410. What do you make of all of it?
Well, it's one more reason why we think that the 10-year Treasury yield on the domestic side will probably stay around that 4% area for the near term, even as the Fed gradually cuts rates over the next 12 months or so. There's a lot of factors that play into the valuation of long-term U.S. Treasury yields, but one is the global landscape. And when you see a pretty big market player, Japan, it's a relatively large bond market, highly rated. When you start to see their yields rise, that can put pressure on U.S. yields because investors might see more value in those international Japanese yields, which could pull demand away from the U.S. So that's something that we're paying attention to. Now, the landscape of who's been buying treasuries has shifted a lot over the years. Japan has actually picked up its purchases year to date at the central bank level. They've been holding around $1 trillion or so for the past number of years, but their influence on the broad treasury market's actually been declining because their purchases actually haven't picked up with our increased supply. So it's something that we're paying attention to, all those international dynamics, but it's one thing, those interest rate differentials that can keep our yields elevated, because if investors, domestic or abroad, can find what they think are attractive yields in other markets, that means we need to find new potential buyers to come to the U.S. and therefore yields might need to stay a little bit elevated, probably in that 4% area.
Yeah, currently we've got the 2-year JGB 17-year high, as is the 10-year, 30-year also at a record high too. So something to keep note of. Nate, let's just get over to you. I mean, my last guest said the green light for a Santa rally is going to be next week if the FOMC does indeed cut by 25 basis points as the market's currently pricing in. Is that what you see out there?
Well, I'd say that the setup is, it looks favorable for the bulls. And I say that because, yes, we all know November, December typically are bullish months for stocks here. But the setup is that, within the NASDAQ, we saw a 7% pullback basically in November, which I think kind of bodes better for December because of that pullback. Meaning, if we were hitting fresh new highs heading into the FOMC next week, I would be concerned about something of a sell on the news. But because we already pulled back in November, that looks good. If you're looking at crypto as a barometer of risk, it's nice to see Bitcoin kind of rebound. I think Bitcoin here over the next several weeks or so basically needs to stay above 80,000. It's looking for some kind of stability. It's looking for some kind of a floor where there's bid support, and it's searching for that right now. So it's nice to see the rebound that we're seeing today. We're also seeing yes, we have the FOMC, so you have bullish seasonality, potentially some performance chasing, potentially a dovish Fed that'll be on the plate here next week. The technicals look okay because all of the major indices are back above their 50-day simple moving average. And then we've got also Oracle earnings. I mentioned this last week. We'll take a look at that. That's going to come up on Monday after the bell. So we'll see what Oracle has to say. Some of the sentiment around some of those heavy debt issuers in the AI segment. I mean, this could be a little bit of a binary event. So Oracle could kind of calm a lot of the investor angst, basically about that heavy debt issuance through results, through heavy, if they have healthy cash flow, healthy profit margins, et cetera, operating margins, that would be good for sentiment around AI. And then, if you look back to just what is the Atlanta Fed GDP, 3.9%. Yes, it's come down a bit, but that's healthy. FactSet Q1 in 2026 EPS growth estimates, double digits. So that's kind of the backdrop. And then if you go to, a lot of the read-through on the consumer and what they're actually doing, their behavior at, Black Friday sales, Cyber Monday sales, they all look healthy across the board, even though consumer sentiment, we know that's been pretty poor.
Okay. And just getting back to you, Colin, I mean, as we look out across the yield curve here, plenty of moving parts, as we mentioned. We've got a lot of commentary about who the next potential front runner could be with Kevin Hassett. As far as some of the reporting is concerned, there has been some conversations around how we could see that steepening, if that is definitely the case. But for now, at least, as we look ahead to the next FOMC decision, not getting anything from Powell. Bowman speaking this morning, but obviously we're in this blackout. We've had some mixed data, particularly yesterday on manufacturing. We'll get services, ISM tomorrow. What are you watching and what's your outlook now for the rest of the year?
Well, we do expect a cut next week, mainly because that's what the market expectations are telling us. If you go back over the past handful of years, the Fed doesn't really like to surprise the market. So with the implied probability of a cut at nearly 100%, we think it's very unlikely that the Fed, wouldn't deliver that. There's a lot of diverging views at the Fed, a lot of disagreements about what the actual path of policy should be over the next few months and quarters. So even if we get a cut next week, I think the path is much more uncertain because we do have this, chorus of officials who are a little bit more concerned about the inflation outlook right now. And more specifically, as we look at the rotation of Fed presidents who are currently voting this year and will no longer vote next year, and then the new swath of voters, there are some, I wouldn't call them hawks because they're not suggesting we need to be hiking rates, but they're hawkish in that they're focusing more on inflation. So when you compare that with the potential for a dovish new Fed chair, potentially Kevin Hassett, I think what that just means is a lot more potential volatility because we'll probably see a lot more dissents. Over the past decade or so, dissents have been somewhat rare, usually only one, maybe two. I think as we get into 2026, we'll start to see, maybe two or three or more, and it'll just show that it will be a spirited discussion, and it's really just going to be majority wins as opposed to a united front, which is what we've had for the past handful of years.
It's a divided Fed, lots of moving parts. We've got to wrap it up there, guys. Thanks so much for joining me today. Collin Martin, Head of Fixed Income Research and Strategy, Schwab Center for Financial Research, and Nathan Peterson, Director of Derivatives Analysis.